What's going on, everybody? I hope you're all having a blessed day, and in today's video I'm going to be talking to you about the commercial real estate classifications and how, if you know this, you can make millions of dollars with real estate investing. Now, not every property is the same property, even if it has the same amount of income. That's important, and I'm going to explain that to you as we get deeper in the video. Also, I'm going to be sharing with you guys my favorite classification out of the three and why I think it's the best one. So stick around and let's get started with the video. And just real quick, guys, if you get any value, please don't forget to hit that free like button. And now let's get started. When investing in commercial real estate, one of the most important things to know is what type of commercial real estate are you wanting to invest in? What kind of tenants do you want to deal with? What kind of lease structures are you looking for? What kind of expectations? What kind of comfort level? And so forth. Knowing the commercial real estate classifications is going to allow you to understand what kind of real estate you want to get into, what kind of money you're going to have to get into it, and also give you a better outlook at what you'll be dealing with. Now, in commercial real estate, there's typically the three main classifications. Number one, Class A, number two, Class B, and number three, Class C. For me in school, I was always Class D and Class D, but thankfully this isn't school. And even though it's not school, you're going to be surprised to realize what classification I like the most and actually make the most money from. Now, each one of these has their own explanation and their own pros and cons, which I'm explaining in this video. And as I'm explaining it to you, I'm going to be giving you my personal thoughts and what I think about them, good and bad. Number one, Class A commercial real estate. Now, typically this is the safest investment you can make, and usually the most expensive ones, because safe always has a price. They are sold at low cap rates because they're just real strong properties. And real quick, for those that don't know what a cap rate is, it's basically the returns on your investment. If you're buying a property at a 10 cap and you're paying $100,000 for it, it just basically means that you're making every year $10,000 net. Low cap rates tend to be for more expensive properties that have less risk. High cap rates tend to be for less expensive properties that have higher risk. Now, Class A properties are sold at a lower cap rate, which means a more expensive price, and these are the reasons why. They are the highest quality buildings in the area and market. Generally speaking, they're newer buildings less than 10 years old. Typically, the highest credit tenants will be occupying these buildings. And most importantly, these properties are called Class A because they demand the highest market rents in the area and cost premiums. If you want to be flashy, have a nice appearance, have a good location, have some amenities, have a good property management on the property, and desired architecture, you have to pay those premiums to rent in that building. Usually you'll find higher tier tenants in these Class A facilities like Starbucks, Kroger, Chipotle, AT&T, and so forth. Credit tenants, which essentially means they've been awarded an investment grade based on their size and financial strength. Now, not all Class A properties have credit tenants, but majority do, which makes them a Class A property. So for Class A, if you're someone who wants to invest in it, more than likely you got a big bank account, you want stability, you want passive income that is more safe with credit tenants and more established tenants as well. It's the safer route when you're investing in commercial real estate, essentially. Now, number two is Class B. It's a safe investment, but still has some risk. Now, we know Class A has some risk too, but it's a lot less. Class B, on the other hand, has some risk and it's a little more substantial. Now, this is a step down to Class A. Now, there are some ways to make a Class B property reach Class B plus by doing certain improvements and such to it. Now, generally speaking, a Class B property is usually 10 to 20 years old and has a mix of low to high income credit tenants, meaning that not all tenants are going to be credit tenants, but you're just going to have a good mix of them. Some yes and some not. Now, rental rates are generally lower than Class A properties because they have some deferred maintenance and work that needs to be done to the properties. They're not Class A taken care of. So those tenants are not going to pay a Class A premium. Also, not all Class B properties have property managers. Maybe it's just mom and pop owned and they're managing it, so they're not doing so well, whereas more Class A properties hire professional property management companies. Not always, but majority of the time. Now, if you have that interest to invest in Class B properties, they're great. They have a little bit more risk, but there is opportunity to put upside in it. And number three, Class C properties, one of the riskiest investments you can make, and just a side note, one of my favorite investments to make. Why? They are literally money machines if you know what you're doing with them. Class C properties are generally 20 years or older and have a ton of deferred maintenance on the property. Owners are generally older, they've held it for a long time, they got bad tenants, they got bad leases, they're not doing upkeep on the property management is not even existent, there's no maintenance, there's no answering calls, there's nothing. Essentially mismanaged, which means opportunity for me and for you who want to invest in it. Now, because of their location and their deferred maintenance, generally speaking, Class C properties have the lowest rental rates in the market. They also lack in amenities and also have lower credit tenants. Lower credit tenants like mom and pops, local shops, people who have their first location, and so forth. The turnover can be consistent if you don't get the right tenant in those buildings. And many times the tenants don't really last in those properties. Now, there are businesses that only look for Class C properties to open their business in. Those will do well, but if you got a 30,000 square foot shopping center, for example, you could be 30, 40, 50% of the time not occupied because tenants just keep turning over and vacancies are high. But for the one who knows how to take advantage of a Class C property, who gets into it, does property management correctly, does the upkeep correctly, does the leases correctly, vets their tenants correctly, does everything needed to make the building look good and attract good tenants, will be the one who makes them into money machines. Class C properties have the most upside, which is why I love them. It's essentially like what I've been doing my whole life at 12 years old, buying phones and flipping them, 15 years old buying cars and flipping them, 18 years old buying houses and flipping them. It's like I would buy something ugly and make it pretty, and the same goes for commercial real estate. Buy an ugly building that's Class C and make it pretty. Once you make it pretty, you can raise the lease rates, you can make the leases stronger, you can get better tenants, and overall, guys, you can triple your investments. I have seen it. I have helped clients do it. I've personally done it. It's the name of the game if you can find the right properties. So there you have it, guys. Those are the 3 classifications for commercial real estate investing. It is so important that you know these 3, Class A, B, and C, and not just hear them, but actually know what each one means, because it's going to help you make better investment decisions. Maybe you don't want so much risk, so you get Class A. Maybe you're ready for risk and you get Class C. At the end of the day, knowing these classifications will help you make the better and smarter real estate investment decision. Now, one thing I want you to keep in mind is just because a Class A property makes the same income as a Class C property, it does not mean they will be sold at the same sales price. Class C is generally more safer, stronger tenants, etc. So yes, it makes the same income, but it has more stability and safety versus the Class C. So they are not apples to apples to compare when you look at the cap rates. That was just a bonus, by the way. Anyways, guys, I love Class C. I love all types of real estate, but Class C is where I see the most money being made. Maybe when I get older, get some gray hairs, and I want more safety, I'll get the Class A properties. But for right now, I hunt Class C every single day. Guys, if you enjoyed this video about some commercial real estate, hit the like button and share this video with somebody else who's looking to invest with you or interested in investing in real estate. And most importantly, subscribe. I upload every single week, and I'd love to see you all. Thank you so much for watching, and I'll see you all later. I'm out.